Have you ever wondered how the U.S. national debt, now over $34 trillion, could ever possibly be paid off? It feels like an impossible number, right? Well, today we're going to uncover the secret, and it's a truth that's hiding in plain sight. It's a mechanism that quietly transfers wealth from your pocket to the government, without a single vote in Congress to raise your taxes. Let's get one thing straight from the start. The United States is not paying down its national debt like you or I would pay off a mortgage. That's the first illusion you need to drop if you want to understand how this massive number can effectively be erased. The real method is something called monetary debasement. It works silently through three main channels: inflation, asset price inflation, and time. So what is monetary debasement? It's when the value of money is deliberately reduced. When the Federal Reserve expands the money supply, which it does through things like quantitative easing or emergency lending, it lowers the purchasing power of every single dollar already in existence. Think of it this way. If you have $1,000 in your savings account and tomorrow the total amount of money in the economy doubles, your $1,000 can now buy only half of what it could before. The debt itself doesn't just vanish into thin air. Instead, it shrinks relative to the size of the overall economy and the total money supply. Here's the simple arithmetic. If nominal GDP, which is the total value of all goods and services produced, goes up because prices are rising, that's inflation, then a fixed pile of debt becomes much easier to manage in real terms. Let's say the government owes $1 trillion. If the economy doubles in size due to inflation, that $1 trillion is now a much smaller percentage of the total economic pie. It's like owing $1,000 when you make $50,000 a year, versus owing that same $1,000 when you suddenly make $100,000 a year. The debt amount is the same, but your ability to handle it has changed dramatically. This isn't a wild conspiracy theory, it's just math. But here's the crucial part, the part that affects you directly. The real danger lies in the distribution. Who benefits when new money is created, and who ends up paying the bill? This brings us to what might be the most important economic concept that mainstream financial media rarely, if ever, explains: the Cantillon Effect. The Cantillon Effect, named after the 18th century economist Richard Cantillon, states that money is not neutral. Its effects are not felt by everyone at the same time or in the same way. Those who are closest to the money printer, think big banks, large financial institutions, the government itself, and major asset owners, get their hands on the newly created money first. They get to spend it before the broader economy feels the inflationary effects. They can buy assets like stocks, real estate, and commodities at yesterday's prices. By the time this new money trickles down to the rest of us, if it ever really does, it's too late. The prices have already gone up. By the time wages adjust, housing is more expensive. Your groceries cost more. Healthcare, education, and energy bills have all risen. This process creates a silent tax on your labor and your savings. Every dollar you earn and every dollar you've saved is worth a little less. At the same time, it acts as a subsidy for those who hold a lot of debt and assets, because the value of their assets inflates while the real value of their debt decreases. This is how the national debt is paid. It's paid by you, but it never appears as a line item on your tax bill. You just feel it every time you go to the store, pay your rent, or see that your paycheck doesn't go as far as it used to. And this isn't some accidental byproduct of economic policy. It's a deliberate strategy. Since the financial crisis of 2008, the United States has embraced a policy known as financial repression. The core idea is to keep interest rates artificially low, often below the actual rate of inflation. When interest rates are lower than inflation, anyone holding debt benefits. The biggest debtor of all? The government. So, by keeping rates low, the government effectively reduces the real cost of its own debt. On the flip side, who loses in this scenario? Savers. Your savings account earning 1% interest is actually losing purchasing power when inflation is at 3 or 4%. This policy is a direct transfer of wealth from savers to debtors. This brings us to a huge myth that has dominated personal finance for decades: the 60-40 portfolio. For years, financial advisors told us that a portfolio mix of 60% stocks and 40% bonds was the perfect balance. Stocks were for growth and bonds were for safety. When stocks went down, bonds were supposed to go up, cushioning the fall. This entire framework was built on a specific set of assumptions: that interest rates would generally fall over time, that inflation would remain stable and low, and that central banks were credible and in control. But we are no longer in that world. We're in an era of structurally high debt, persistent government deficits, and a clear political unwillingness on both sides to make the hard choices and cut spending. In this new reality, the old 60-40 model breaks down. When inflation spikes, as we've seen recently, the value of existing bonds plummets. Why would anyone want your old bond paying 2% when they can buy a new one paying 5%? And when central banks are forced to raise interest rates to fight that inflation, stocks also take a hit. Higher rates make borrowing more expensive for companies, hurting their profits, and they also make safer investments like government bonds more attractive relative to risky stocks. Suddenly, stocks and bonds are falling at the same time. Their correlations converge towards one, and the safe part of your portfolio is no longer safe. The social consequence of this entire system is what many now call the K-shaped recovery. After an economic shock, like the one we saw in 2020, you see a sharp divergence in outcomes. Asset owners, those who own stocks, real estate, and private equity, see their wealth rebound aggressively and often soar to new highs. They are on the upward-sloping arm of the K. Meanwhile, wage earners, small savers, and those who rely on a fixed income find themselves on the downward-sloping arm. Their real wages lag behind inflation, and their slice of the economic pie gets smaller. Just look at the data since 2020. The stock market hit record highs. Housing prices went through the roof. The wealthiest saw their net worth explode. At the same time, millions of families struggled as the cost of living outpaced their income. That divergence isn't a temporary glitch in the system. It is a feature of a system designed to inflate away its obligations rather than confront them head-on. So, when you hear politicians arguing about the debt ceiling or debating trillion-dollar spending bills, remember what's happening behind the scenes. The real debate isn't just about the numbers on a spreadsheet. It's about who will ultimately pay for it all. And the answer, increasingly, is that it's paid for by a subtle, continuous erosion of your purchasing power. It's a transfer of wealth that happens so quietly, most people don't even notice it's happening. Understanding this mechanism is the difference between being a victim of it and being prepared for it. It's the difference between being confused and frustrated by rising prices and recognizing the game that is being played. The system isn't designed to make you rich. It's designed to service its own debt. If this analysis has challenged what you've been told about how the economy works, then you're in the right place. So, where is all this heading? Let's trace the logical path, because complex systems don't just drift, they move towards their limits. As government debt continues to pile up and inflation becomes a stubborn, persistent problem, the people in charge find themselves stuck between a rock and a hard place. On one hand, they could let interest rates climb. This would help fight inflation, but it would also risk triggering a cascade of failures. Think about it. Governments, major banks, and even entire asset markets are addicted to cheap debt. A sharp rise in rates could make it impossible for them to pay what they owe. Insolvency on a massive scale becomes a very real possibility. On the other hand, they could keep interest rates artificially low, effectively suppressing them. This keeps the debt machine running, but it comes at a huge cost: the debasement of our currency. In simple terms, your money loses its purchasing power. History gives us a pretty clear answer about what happens next. When a country gets this deep into debt, it almost always chooses the path of financial repression. It finds ways to force savers to accept returns that are lower than the rate of inflation. This is where the idea of central bank digital currencies, or CBDCs, moves from the realm of science fiction into serious policy discussions. You're hearing about them more and more from central banks all around the world, including the Federal Reserve. A digital dollar is often sold to the public as a simple modernization project. They'll tell you it means faster payments, a more efficient financial system, and greater financial inclusion for everyone. And on the surface, those things sound great. But if you look at the underlying structure, a CBDC enables something that physical cash fundamentally cannot: programmable money. This is a game changer. With a fully digital currency controlled by the central bank, interest rates could be applied directly to the money in your account. They could make the interest rate deeply negative to force you to spend, or positive to encourage saving. Your spending could be algorithmically incentivized or discouraged. Want to buy a plane ticket? Maybe the system flags it. Trying to buy more than your fair share of gasoline? The transaction could be blocked. Capital controls, which are restrictions on moving money out of the country, could be switched on with the flip of a digital switch. Now, why does this matter so much in a world drowning in debt? Because negative real interest rates, where the rate of inflation is higher than the interest you earn, are not an accident. They are the feature, not the bug. They are the intended solution. If policymakers need inflation to run hotter than bond yields to slowly and quietly inflate away the value of their massive debts, they also need to make sure that savers can't just run for the exits. They can't have everyone pulling their money out and moving it into things that will protect their wealth. A CBDC combined with the slow disappearance of physical cash dramatically reduces your options. It corrals everyone into a digital system where the rules can be changed at any time. It's not about some grand conspiracy for tyranny. It's about expanding the policy toolkit to manage an unmanageable problem. It's about control. At the very same time, the places we've traditionally run to for safety are coming under immense pressure. Government bonds, long considered the ultimate safe haven, lose real value every single day in an inflationary environment. You get your money back, but it buys you less than when you started. The stock market becomes a roller coaster as unpredictable changes in interest rates and inflation expectations cause wild swings in valuation. And real estate? It's facing a double whammy of severe affordability issues for new buyers and increasing political risks like higher property taxes or rent controls. This is precisely why you're seeing a surge of interest in alternative assets. People are looking at hard assets, commodities like oil and copper, and monetary metals like gold and silver. What do these have in common? They have a limited, finite supply and they don't carry counterparty risk. A bar of gold is not someone else's liability. Its value doesn't depend on a government or a corporation's promise to pay you back. Let's be very clear. The financial system isn't going to collapse tomorrow. But it is absolutely in a state of transition. The United States is quietly, but deliberately, choosing inflation over austerity. Why? Because austerity, the idea of seriously cutting government spending and raising taxes to pay down the debt, is politically toxic. It's impossible in today's political climate. So instead of repaying the debt, it's being managed through dilution. The value of the debt is being eroded by creating more and more money. The ultimate irony in all of this is that the entire strategy hinges on trust. We are asked to trust that this bout of inflation is just temporary. We are asked to trust that our institutions will always act in the public's best interest. We are asked to trust that someday we will once again be able to earn a real positive return on our savings. But history tells a very different story. Great empires throughout time have rarely defaulted on their debt outright. That's too obvious, too messy. Instead, they debase their currency. They clip the coins, they print the money, they dilute the value of what everyone holds until the debt becomes manageable again. Understanding this dynamic doesn't mean you need to panic. It doesn't mean you should go out and build a bunker. But it does require a healthy dose of realism. The purpose of this video isn't to give you financial advice or tell you what specific assets to buy or sell. The goal is to explain the mechanics of what is happening, to connect the dots, so that you can think for yourself and make informed decisions. That massive number you see on the news, the national debt, now over $34 trillion, isn't just an abstract figure. It's a real claim on future economic output. It's a claim on your future purchasing power, and your children's future purchasing power. And every single time the money supply is expanded faster than the real productivity of the economy, that claim is settled. It's settled by reducing what each dollar can buy. That is the hidden mechanism. That is how a multi-trillion-dollar debt can be paid without ever truly being paid back. And that is why the real cost of this debt is showing up everywhere, in your grocery bill, at the gas pump, in your rent, everywhere except where most people are being told to look. Thanks for watching. If you found this helpful, consider liking the video and subscribing for more content that helps you see the bigger picture.